I'm Dan Stous, lead wealth advisor here at Flagstone with another market update. And today we'll be discussing oil price trends and how that might impact the markets and the economy. Now, this is important right now because the S&P 500, which is a group of large U.S. company stocks, has experienced its first 5% pullback of the year. Markets have been just kind of jittery in the past few weeks. And that's largely due to the Fed, pullback in tech stocks, and increasing tensions in the Middle East. Now, it's important for investors to remember that short-term pullbacks are a natural and expected part of investing. And rather than focusing on the day-to-day market movements, it's far more important to understand long-term trends. And oil prices are one of those. So over the next few minutes, let's discuss how geopolitics and oil prices might impact those broader market trends over the next several months. First, oil prices have risen about 8% so far this year, but they're still well below the recent peaks. That recent peak that you see on this chart occurred in early 2022 when Russia invaded Ukraine and oil prices jumped above $120 per barrel. Now, that episode is important because high energy prices drove inflation as well. This was one reason the Fed had to act as swiftly as it did in hiking interest rates to prevent prices across the economy from increasing further. Higher energy prices, including gas prices at the pump nearing $5, was one of the reasons many economists feared that a recession would occur. So oil prices are a way in which global events can impact markets. Investors are especially sensitive to this today because of the effects oil can have on inflation and Fed policy. Second, a key difference between today's environment and the past is that the U.S. is the largest producer of both oil and gas in the world. Now, in theory, this helps to insulate the U.S. from global events, at least when you compare it to like the 1970s, for example. And when you look at this chart, you can see a major dip in production during the COVID-19 pandemic, but you can also see that the production has fully recovered since then and now exceeds 13 million barrels per day. Now, despite the fact that the U.S. is the largest producer of oil in the world and that production is at its peak, we're still dependent on global energy markets. Not only does the U.S. still import foreign oil due to differences in the type and quality of oil here and abroad, but oil is a global commodity. So price fluctuations can impact us as U.S. consumers as well. All that to say, higher oil prices have certainly impacted inflation, and they have so far this year. Great uncertainty around inflation also impacts the timing and path of Fed rate cuts, which the market is highly sensitive to. Finally, these factors not only affect broad economic outlook, but impact investment portfolios as well. And we have one more chart to speak to that. Each column of this chart represents a calendar year, and each colored block represents a specific sector, like energy, tech, or financials, for example. The best performing sector of a specific calendar year will be at the top of the column, while the worst performing sector of that year will be at the bottom of that column. This chart shows that the energy sector, which is that red block, is now the best performing group in the S&P 500 this year, especially with the decline among tech stocks. What's interesting is that the energy sector has behaved quite differently from the rest of the market over the past several years. You can see from 2014 to 2020, energy was among the worst performing groups due to overproduction and a collapse in oil prices. You can see that red block at or near the bottom of those columns. But the energy sector surged in 2021 and 2022 as the global economy bounced back. Now, while the past is no guarantee of the future, it shows that the energy sector is an important component of a diversified portfolio that can help balance risk. We preach this all the time, and it's a core philosophy of ours, but I'll say it again here. Stay diversified and maintain a long-term investment approach. Don't let short-term swings in the energy sector or any other sector for that matter impact your investment approach. While things like oil prices do tend to impact Fed policy, which can then in turn impact broader markets, 5% pullbacks like we've seen in the S&P 500 over the last few weeks is a natural part of investing. As investors, we expose ourselves to the risk of loss, which tend to be short term. But as compensation for taking that risk, while it's no guarantee, we tend to get rewarded in the long run, especially if we can stay the course. Now, I hope you found these insights helpful. If you're a Flagstone client, we thank you so much for your relationship. If you're not a client but you're interested, visit our website at flagstonefm.com to learn more about what we're all about. Thanks for watching.